UTI Balanced Advantage Fund. Stock markets have proven to be a rewarding playground for patient investors. Those who have remained steadfast in their investments have reaped generous returns even amidst the ebb and flow of various events and market phases. Take for instance an investment made in Nifty 50 Total Return Index 20 years ago. Showcasing a remarkable compounded annual growth rate, stock market has delivered returns of 15% over the last 20 years. It's a testament to the power of long-term vision and resilience in the face of market fluctuations. However, not everyone can commit to staying invested for such extended periods, can they? It's true that only few investors have truly benefited from the stock market's journey over the past 2 decades. But have you ever wondered why that is? Market volatility can be intimidating. Indeed, it's only natural to feel a greater inclination to invest when the market is in a booming phase and confidence levels are soaring. Let's face it, market ups and downs are what we commonly refer to as volatility, can make investment decisions challenging. As investors, let their emotions guide their choices. As noted by esteemed investor Howard Marks in his memos, they inadvertently contribute to market volatility. While the GDP has grown by over 12% in last 20 years, the volatility in its growth is less than 6% compared to over 25% volatility in Nifty 50 TRI returns in the same period to generate 15% returns. The journey of stock markets over the years has been akin to a roller coaster ride, with its fair share of sunny days and rainy spells. However, who truly enjoys unpredictable weather? This volatility inevitably casts a shadow over investment decisions. How does this volatility influence your investment decisions? Let's understand. Investors often tend to enter the market or increase their investments when the markets are rallying and market euphoria is at their peak, as they are driven by their emotions. However, it is important to note that valuations tends to be expensive during such period, potentially resulting in returns falling short of expectations. Conversely, when the market experiences a downturn, investors often feel the urge to exit to avoid the potential losses fueled by the fear of further declines. Surprisingly, this is precisely when investors could potentially earn better returns by increasing their investments, as market valuations are typically more reasonable during such times. These sentiments of greed and fear are recognized as emotional or behavioral biases, and their influence on the investor's journey of wealth creation and experiences cannot be overstated. These behavioral biases can lead to investors earning less than what their actual investments would have earned, creating the behavior gap. Studies have shown that investors have potentially lost 2.8% for a 10 years investment because of the behavior gap. To put it in perspective, if you had invested 1 crore for 10 years, this 2.8% CAGR of potential gap in return could have costed you approximately 71 lakhs. Okay, investing in equities can be intimidating, especially for those who are wary of market volatility. However, allocating a portion of portfolio to fixed income investments offers a potential solution. Let's see how asset classes have different risk and return profile, and the relative negative correlation between equity and fixed income can help in diversifying the risks typically associated with pure investments. And optimal mix of equity and fixed income assets can help investors in generating better risk-adjusted returns and navigating market volatility with greater ease. If we simply invest 50-50 between equity and fixed income, we may observe a reduction in returns, but volatility would also decrease. One does not have to predict whether to prepare for rain or wear a raincoat, or for sunshine and take out sunglasses. However, asset allocation should not always remain at a 50-50 ratio. To capitalize on various market scenarios, adjusting the allocation between equities and fixed income becomes necessary. Investors often try to follow a do-it-yourself or a DIY approach for asset allocation. However, determining the optimal asset allocation and rebalancing the portfolio to align with ever-evolving market dynamics can prove to be very challenging. First, analyzing securities and constructing a portfolio can be very difficult by yourself. Second, emotions can cloud judgment, leading to impulsive and irrational decisions. Third, taxes adds to the complexity. Lastly, constantly monitoring and rebalancing the portfolio demands time and effort. Seems quite a task to handle it solo, doesn't it? This is where we step in to lend you a hand. UTI Balanced Advantage Fund simplifies the process of asset allocation and portfolio rebalancing by investing in portfolio of equity and fixed income, while dynamically adjusting the asset allocation with changing market valuations. Take it easy, whether it's a sunny day or a rainy one. UTI Balanced Advantage Fund offers one-stop asset allocation solution, offering diversification and a disciplined model-guided approach to dynamic portfolio rebalancing. The fund endeavors to deliver better risk-adjusted returns across market cycles to help investors achieve their financial goals over the medium to long term. Let's dive deeper into how it works. How does the fund diversify the portfolio? UTI Balanced Advantage Fund allocates between 30% to 90% in net or unhedged equity. To maintain equity taxation, the fund always maintains a 65% gross equity weight, with the remaining portfolio invested in fixed income assets. Who decides the allocation between equity and fixed income? Asset allocation is a dynamic process. The fund's net equity rate is determined by our in-house proprietary asset allocation model. Therefore, investing in the UTI Balanced Advantage Fund means you don't need to monitor or rebalance your portfolio. Additionally, you only incur taxes when you redeem your investment. UTI Balanced Advantage Fund follows a disciplined model-guided approach for dynamically managing asset allocation to eliminate any behavioral biases. Wondering how does the model work? Let's understand. The asset allocation model analyzes multiple years of historic data and determines optimal equity allocation based on fundamental and valuation-driven factors that have been proven for having correlation with the market forward returns. Let's break it down further. Fund assesses 4 factors: PE, PB, dividend yield, and yield gap to determine optimal equity allocation. Where PE and PB have negative correlation with market forward returns, which means if PE and PB are high, equity markets are expensive. Hence, reduce the equity allocation and vice versa, sell high and buy cheap. The other 2 factors, dividend yield and yield gap, are positively correlated with the market forward returns, which implies if dividend yield is higher, it's a green signal to increase allocation to equities. Yield gap compares equity earnings yield with 10-year G-Sec yield by taking a difference between the two to offer an inter-asset comparison. This approach provides a holistic view to the model. When the gap widens, indicating a favorable condition for equity over fixed income, it signals an increase in equity allocation, where you constantly observe the road ahead through the windshield while also checking the rear view. Our model assesses both forward and backward-looking factors to ensure a comprehensive view of the evolving market dynamics. Has the model lived up to its promise? Let's delve deeper to uncover the back-tested results and see how it has performed. As can be seen in the chart, the model has demonstrated its efficacy in navigating market volatility and determining the optimal equity allocation. This has reflected in the back-tested performance outcomes as well. The back-tested performance outcomes reflect that the model has not only delivered superior risk-adjusted returns compared to Nifty 50 TRI by reducing the volatility of a pure equity portfolio, but has also outperformed the benchmark, as the model demonstrated its effectiveness during both market upswings and downturns. The model has efficiently captured more upsides than downsides, which means the model has demonstrated high participation in market upswings while offering protection during downturns. So whether the market offers you a smooth ride or bumps of volatility drive to your financial destination with comfort, The UTI Balanced Advantage Fund having grasped the model and its effectiveness. Let's now explore the portfolio strategy of the UTI Balanced Advantage Fund. Before diving into the details of investment strategies, it is important to understand the sources of alpha creation in the fund. The primary source of alpha stems from asset allocation and sector and stock selection for the equity portfolio. The first step of asset allocation is taken care by the model, while the fund managers actively manage the equity and fixed income portions of the portfolio. The primary role of fixed income is to provide stability to the overall fund portfolio. Curious about the investment strategies for equity and fixed income portfolio? The fund manager employs a blend style of investment, growth and value for the equity portion for the portfolio. The fund manager uses a bottom-up approach for stock picking with the ability to invest in stocks with long runway for growth and may participate in cyclical opportunities including turnaround companies. We have consciously chosen a blend approach as we feel it is better suited to the objective of this strategy. Further, the equity portfolio will have a large cap bias 80% or higher to facilitate efficient asset allocation changes during portfolio rebalancing. And what about the fixed income portfolio? The fund invests in top-rated issuers predominantly through AAA equivalent rated issuers, as the objective here is to bring portfolio stability. This acts as a sturdy umbrella, protecting your wealth during market downturns. Now that we have explored the UTI Balanced Advantage Fund's offerings, don't you think it's the perfect companion for your investment journey? We have observed how emotional biases can create a potential gap in investor returns, leading to suboptimal experiences. Additionally, challenges associated with asset allocation and portfolio rebalancing in response to changing market dynamics are evident. Therefore, the UTI Balanced Advantage Fund, which offers a diversified portfolio of equity and fixed income, can assist investors in capitalizing on the return advantage of equity alongside the stability advantage of fixed income with its model-driven approach to dynamic asset allocation. The fund eliminates behavioral biases and aids investors in generating better risk-adjusted returns in a tax-efficient manner. UTI Balanced Advantage Fund provides the opportunity to invest in a blend of equity and fixed income, model-based dynamic asset allocation and rebalancing of portfolio, tax efficiency. To know more, contact your mutual fund distributor or registered investment advisor or call 86550 19940.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.